So this jumped almost 2.5 points in 90 days while we're in the midst of a pandemic. Hey everyone, Travis Spear with Pine Financial Group, where we work together so you succeed. Thanks for joining me today on this video. Hope that you have the opportunity to hit subscribe, like, or comment below so that we can have a conversation about the content that we're bringing you. We're bringing fresh new videos every Friday, so be on the lookout. Today, we're going to talk about home ownership rates. A new statistic came out for the second quarter of 2020. It's important to understand a home ownership rate and what it means and how it's calculated. So it's calculated by looking at the total households across the United States and what percentage of those are owner occupied. Now, is this indicator important? It kind of depends. If you look back historically, you can kind of see where our numbers hung out, and we'll get into that. But it is one indicator to give you an idea of the strength of the real estate market, or potentially give you something to look at to understand what might be coming. So at the end of the first quarter in 2020, the home ownership rate was 65.3%. And in the report that just came out for Q2, we're showing a home ownership rate of 67.9%. So this jumped almost 2.5 points in 90 days while we're in the midst of a pandemic. This is pretty impressive and goes to show maybe how strong the real estate market is. To give a little bit of perspective, 1 year ago, the home ownership rate was 64.3% and hung out around 64% for the last few quarters, so relatively flat. And it jumped to 65.3 over the last 12 months. And then, as I mentioned, the last 90 days is 67.9. To give a little bit of background on where this has been in the past, when we were at the peak of the real estate market in 2004, early 2005, the home ownership rate was at 69.4%. So not too far from where we are today. In fact, if we had another quarter like the last quarter, we could surpass the last highest level of home ownership in the United States. So what does this indicator mean? Some people may have thought at the time, looking back, that was leading us into the Great Recession and the mortgage meltdown. But today, mortgages are different. The loans are underwritten a lot more stringent. We have higher DTI requirements. We have the requirement that you actually have a job. We don't have 100% financing. In 2004, 5, 6, you could get loans where not only did you not have any money down, but you could have got money out. Lines of credit and second mortgages were very easy to get above the value of your home. And a lot of people were taking those out and doing different things with them that didn't include paying on their house. So the credit market is different today than it was then, which gives some idea that the borrowers should be stronger than they were at that time. That's good to know, because although it's climbing for good reason. Another thing that's really important to look at is the inventory. When we look back to what the inventory was right before the mortgage crash, was very high in most markets. In fact, in our Denver market, I think it's probably close to about 6 times the inventory or higher than we actually have today. So inventory is tight, and loans are being underwritten more tightly. So that tells us that the market is performing. With a low amount of inventory across the United States, as far as months of inventory, it's pretty competitive out there, especially in resale homes, can be competitive in new homes too. And with the pandemic coming on, some of the housing starts have slowed. Now, the National Builders Association will still report that it's been pretty much the same, or maybe even a little higher. But if you look around at local job sites in your own market, you might get a better idea of how things are progressing. So the inventory is driving prices. But what's making this all work is our record low interest rates. And what's interesting right now is interest rates are under 3%. So it's actually, I was just reading an article recently that it's actually more affordable now to buy a house than it was maybe just 6 or 12 months ago based on interest rate alone. When looking at affordability, that's going to be different for everyone, as prices have gone up significantly in the last 10 years in almost every real estate market. But when we look at the interest rate and how it creates affordability or purchasing power, let me give you an example of how powerful the interest rate could be when you're looking for a loan. A $400,000 mortgage at a 4% rate would have the same payment as a $455,000 mortgage at a 3% rate. So the buyer would gain, what's that, almost 12% in purchasing power by 1% rate drop. So if somebody's been out shopping for a while and maybe getting beaten out, now they might have the opportunity to go to a little bit higher price point and have the same payment. And these are fixed rate mortgages locked in for 15, 30 years, whatever your poison is. And that gives you the opportunity to ensure that your payment is going to be the same. When looking at a $400,000 mortgage, a difference in interest rate by 1% changes the payment by about $250 a month. So it wasn't that long ago that a good interest rate was roughly 4.5%. And if you were at roughly the median household price in our own market here in Denver of around $400,000, your difference in payment from just 2 years ago would be upwards of $500 a month. $500 a month is different for everyone, but if you look at the purchasing power, that's a difference of about 30% in payment, the difference being from 1,500 to a little bit over 2,000. So low interest rates are helping people to continue to buy houses and see it to be a good investment over renting. Another statistic that was in the report showed the national vacancy rate for rental properties, which in the last quarter went down by almost a full point from 6.6 down to 5.7. Now, I know a lot of places have eviction moratoriums, and some places are going to be hit harder than others when that finally is lifted, and we'll have to see how that shakes out. But in my own rental portfolio, I'm seeing that most tenants are able to make their payments with a few workouts and delaying full rent due. Tell me below what you think this means for our real estate market in your own local market, or maybe even nationally, what an increased home ownership rate means. And do you think it's possible that by the end of the year, our home ownership rate surpasses the last record of 69.4%? Love to hear from you on that. Check us out online at www.pinefinancialgroup.com. We're a hard money lender. We raise and lend private money and lend money to real estate investors for fix and flips, new construction, and commercial value add projects. We'd love to hear from you. Thanks.